2 years ago, Zimbabwe faced or lived through its worst drought in 40 years. More than half the harvest gone. Maize down more than 70%. And by the government's own estimate, more than 7 million people were at risk of going hungry before the next harvest came. And $32 million of insurance money arrived to help. Almost none of that $32 million came from the industry sitting in this room. Good morning. It's an honor to be here with you this morning. Now, that opening line is true, but it's not the whole truth. And the rest of it is more interesting, a lot more interesting. I will come back to it later, but when I do, some of you will recognize the story. I want to spend our time this morning on what I think is the largest commercial opportunity any of us will see in our careers. Now, I could give you the comfortable version of this talk, that climate change is serious, that we need more data, more dialogue, more disclosure, and all of it is true. But none of it is useful to you next week, or all of us next week, when we get back to work on Monday morning. So let me start with the harder claim. Climate change is not a future sustainability issue for this industry. It's a present business issue. And it was in your numbers 2 years ago, whether or not anyone called it that. Which leads to the question I want to leave with you at the end. And I'm going to pose it to you now so that we can think about it while I talk. If climate risk is reshaping every sector of the economy we insure, how should it reshape the way we design insurance? Let me say that again, because everything from my talk hangs off it. If climate change is reshaping every sector of the economy we insure, how should it reshape the way we design insurance? Now, let me set the scale and then bring it back home. Our entire industry rests on a single assumption, that the past is a reasonable guide to the next 12 months. We rarely say it out loud, but every treaty, every rate, every reserve leans on that assumption. And climate change is quietly dismantling it. The weather is becoming less predictable, more extreme, more expensive, and a lot more scarier. And the loss history we price against is becoming a weaker guide to what comes next. That is not an environmental problem. It's a pricing problem. It sits at the center of what we all do. Now, over the past 60 years, Africa has warmed faster than the global average, and the UN's weather agency has been blunt about why we are so exposed. A heavy dependence on rain-fed agriculture, limited financial resources, and limited capacity to adapt. They put the cost of adaptation in sub-Saharan Africa at tens of billions of dollars per year over the next decade or more. Somewhere around 2 to 3% of this region's entire economic output, indefinitely. That is a permanent, structural, uninsured loss, falling on the households, on the farmers, and the small businesses least able to absorb it. It's not a humanitarian statistic. It's the largest protection gap on Earth. And Africa did not cause it. We all know that. This continent barely shows up on the emissions that did. The carbon was put there over 2 centuries by the industrialized economies of North America and Europe, and more recently, even Asia. We didn't build the furnace, but we're standing closest to the fire. Now, if I can bring it back home, let's look at the last 3 seasons that hit Zimbabwe, because the pattern matters more than any one of them in isolation. So if we move back 2 years ago, an El Nino ranked among the most severe on record. Southern Africa received less than 1/5 of its typical rainfall. It struck at exactly the wrong moment, which was the planting season. Crops failed, livestock died. 6 countries declared a state of emergency. And in April 2024, the president declared a state of disaster in Zimbabwe. Going forward 1 more year to this year, the total opposite happened. Heavy rains and flash floods across Zimbabwe in the early months of 2026. Lives were lost, hundreds of thousands of people affected. Hundreds of schools were damaged, and a bridge was even washed away. Now let's look forward. The season that starts with the first rains in November, in a few weeks from now. Every major forecasting center is now saying the same thing. A very strong El Nino is forming, with a high probability that it ranks amongst the largest events in the record dating back to the 1950s, and near certainty that it will persist early into next year. Your own weather service has already issued a preliminary warning. Historically, El Nino conditions in Zimbabwe carry roughly a 65% likelihood of below normal rainfall. The definitive national outlook is still a few weeks away, but let me be precise about what I am and what I'm not saying. I'm not forecasting a drought. I don't forecast weather for a living. I'm an accountant and a director, and this room doesn't need someone who does. But farmers start buying seed and preparing land within weeks. Cover for that season has to be designed, has to be priced, and sold before any of it goes in the ground. So we are being asked to make decisions about the coming season before the confirmation arrives. This is not a weather problem or a climate problem. It's actually an underwriting problem. Look at what happened. Drought, then flood, then quite possibly drought again, just inside 3 seasons. And I'm not going to describe your own country's experience back to you. You lived it, I didn't. What I want to ask is a different question. What did it do to your business? Because that is the part we discuss the least. We talk about climate as a claims event, a flood, a fire, a catastrophe loss, something that arrives, gets assessed, gets paid. But most of what a drought does to an insurance business never appears on a single claims form. It shows up in 3 places instead: in your loss experience, in your asset values, and in the economic resilience of the market we depend on. And it reaches all 3 through 4 parts of your own book. All 4 are already sitting in last year's results, and I'm going to go through them one by one. Let's start with the motor book. A drought does not damage cars, but it destroys disposable income. Comprehensive cover becomes third party, and third party becomes no cover at all. Lapse rates climb, and debit orders bounce. None of that arrives labeled as climate risk. It arrives as a persistency problem and is discussed in a management meeting as such. But it was as a result of a drought. Secondly, the commercial and small business book. The small business is, in a farming district, does not have a crop to lose. It has customers. And when those customers have no income, the business has no revenue. A business with no revenue does not renew, does not upgrade, and eventually does not exist. Your policy count in agricultural districts fell, not because anyone canceled after a claim event or a claim dispute, but because the underlying economy that generated those policies contracted and got smaller. Thirdly, our credit and collateral exposure. Whenever this industry stands behind lending, credit life, credit guarantee, or simply insuring assets financed on credit, a failed agricultural season moves through the system with a lag or a time delay. Loans go into arrears, collateral values fall, recoveries weaken. That shows up in our numbers 18 months later, and by then, nobody is calling it a drought. They are calling it a deterioration in credit quality. And fourth, finally, our investment portfolio. We are long-term investors, and I know there's certain restrictions around long-term and short-term, but by nature, we are meant to be thinking in the long term. We hold government paper, listed equity, property, and a drought takes a chunk out of that national output, pressures the currency and squeezes the fiscus. And it doesn't leave an insurance balance sheet untouched. All of our assets get impacted by that. It's taking value of our assets at exactly the moment or the same moment we are adding to our claims, which is the definition of a correlated risk, and the one thing our entire discipline is built to avoid. So when we look at our catastrophe treaty and conclude we are broadly defined, we are looking in the wrong place, or I believe we are looking in the wrong place. Climate risk did not arrive in this market as a claims event. It arrived as a lapse rate, as credit quality, as premium growth, as asset values. It was distributed quietly across every single line of business, and it was never once labeled. And here's why that matters more today than it did last year. Those same 4 channels and how the next one arrives, not through your catastrophe program, through persistency, through premium growth, through credit quality, and through your asset side. If the season turns, it will show up exactly where it showed up last time. The difference is that this time the warning did come first. Now, earlier on, I promised I would come back to that $32 million US. Where did it come from? It came because Zimbabwe prepared years before the drought arrived. One of the first African countries to join the African risk capacity, as was mentioned, as was referenced earlier. It bought a sovereign parametric cover, paid premiums with the support of development partners, and did the planning. There was an implementation plan sitting ready before the shock came. And when the drought hit, it wasn't just one payment of $32 million US. It was broken up into three distinct components. Firstly, the government received $16.8 million US. Thereafter, the World Food Program received $6.1 million with which they purchased food for people. And finally, almost $9 million to the START network. The Minister of Finance said at the time it would reach around 500,000 vulnerable lives or 500,000 vulnerable households across 27 districts. Let me say plainly what it is. That is insurance working in Zimbabwe when it matters most. Zimbabwe is not the cautionary tale in the story. Zimbabwe is the case study in doing it right. But that cover was not written by this industry. It was arranged through an agency of the African Union, underwritten in a sovereign risk pool, supported by development finance. It protected the state, so the state could feed people. But here is the part that gets told the least. That was not the only insurance that paid out on that drought. In October 2024, in Goromonzi, close to 1,800 smallholder farmers received payouts from an index-based product. Each had paid about $15 US in premium, and each of them received around $65 US. The total claim came to approximately $230,000 US, a lot less than the 32 million I mentioned earlier. That product, again, as referenced earlier, was the farmer's basket, a bundled weather index and area yield product. It was written through the Agro insurance pool, established under this council's own special risk consortium, with AFC Insurance as lead insurer. It came out of a market development initiative driven by this commission, or the commission, with the IFC and others alongside. And the Minister of Finance was there to hand them over. So the honest question is not why nothing came from this room, it's why so little perhaps did at face value. And it has not stood still since. That single district in Goromonzi became 68 wards the following season. Across 8 provinces, 20,000 farmers signed up. The target for this season is higher again, with livestock added. And in the last few weeks, a program has launched letting farmers pay their premiums in grain rather than cash. That is real, and that is this council's pool. But here is the number I keep coming back to. As I was researching it, I couldn't get my head around one thing. Of those 20,000 that signed up, fewer than 1,000 actually paid the premium. So follow it through with me. Goromonzi covered 4,000 farmers and about 1,800 got paid. The national rollout reached 20,000 and fewer than 1,000 were paid. Reach grew 5-fold, but uptake did not follow, which is the harder problem, and the one nobody in the business has solved yet. Getting a product to people is not the same as getting people to take it. And hold that against what it was up against, 1,800 farmers and $230,000 US, against the drought in which the government's own estimate put more than 7 million people at risk of hunger, and in which the response cost the state billions. That is not a failure. It's a proof of concept, and a very, very, very strong proof of concept. The mechanisms work. Somebody built it, priced it, and paid it in this market, under conditions most insurance industries on earth never have to work under. So what's missing is not the machinery. The machinery works well. What's missing is everything building between it. The thing, everything between building the thing and getting somebody to buy it. And be honest about why the scale is missing, because it's not for a lack of want of effort. The Commission's own reports have said that the same thing for decades. Motor and fire are the dominant classes, and it's not even close. Motor alone is about half of everything this industry writes. Add fire, and we are at almost 2/3, or even over 2/3. And after adding personal accident, farming, and engineering, that's past 80% of the industry. There is nothing wrong with those lines of business, except this one thing. Those lines of business protect the assets of an industrialized economy. They were never designed to protect the farmer against the sky. So when the worst drought in 40 years arrived, the market did exactly what it was designed to do. And there was no drought in the design. One small deliberate exception of paid 1,800 people. Everything else fell straight through the gap where a product should have been, which raises the obvious question. Why is that the book that we have? Why is it the insurance book of business that we have? And Why does an industry sitting on the most climate-exposed continent on Earth still write only motor and fire and property? And the answer is actually older and deeper than anyone in this room. It explains a great deal, and it blames no one. Insurance, as we practice it, was not built for us. It was built in London and in Zurich and then exported to Africa, largely intact, fire and motor and everything else. Think about what we inherited, or what that product inherited quietly assumes. It assumes 4 things, and on this continent, all 4 are not correct. First, cash. It assumes people have bank accounts on a continent where most adults reach for a phone, not a bank. Secondly, it assumes trust. It assumes that an insurer will pay in markets where too few people have ever seen that happen. Thirdly, speed. It assumes stable, predictable risk on the most volatile risk continent on Earth. And finally, fourth, culture. It assumes the individual policyholder in societies where risk has always been shared. 4 assumptions, 4 gaps, and none of them are small. And I want to flag the second one, which is trust, because it's the hardest of the 4, and I'm going to come back to it later on. So the product does not reach the smallholder farmer. It was never designed to. Of course, it cannot price a peril with almost no loss history. Of course, it cannot settle in a week when the machinery assumes an assessor, a long form to complete, and a process to work through. Our products are not failing. They're doing exactly what they were built to do, but they were just built somewhere else for an industrialized economy. So the question is how, not how we fix what we were given. It's what do we build instead? And before I get to what we build, let's be clear about who we would be building it for, because it changes the commercial case entirely. And I want to start by naming an assumption that sits buried in our industry, whether it's Southern Africa or Africa in general, and it rarely gets said out aloud. It's that the assumption that the mass market is uninsurable. The mass market is too poor, too remote, too small a premium to bother with. And I honestly believe that the mass market is not uninsurable. Some we cannot reach, some we can reach but cannot price yet. Neither of those means they should go unprotected, and neither is a permanent condition. They are engineering problems, and this industry solves engineering problems for a living. Because the scale of what we are leaving alone is not marginal. The majority of this economy sits outside the formal financial system. However you measure it, by employment, by output, by counting businesses, the formal sector is the minority, and it has been shrinking for years. I want to be careful about how I say that, because it's usually said as a social observation. And I don't mean it as a social observation, I mean it as a market one. The majority of an economy is not a niche. It's the largest addressable market any of us will encounter in our working lives, and it's currently served by almost nobody or very few. This is a financial inclusion problem before it's a climate problem, and they are the same conversation. And it's not only the households, the small businesses in the economy, the ones I described losing customers rather than crops, are largely uninsured too. Formal enough to have assets worth protecting, but informal enough that nobody has designed a product for them. And that is a segment on its own, not just a footnote. And in agricultural specifically, around 7 in 10 Zimbabwean farmers are smallholders. They grow the bulk of what the country eats on rainfall they cannot predict, with no protection at all. An inclusive insurance market is not a charitable one, it's a complete one. A market that reaches the whole economy it operates in rather than the formal fraction of it. And there is no version of climate resilience for Zimbabwe that does not run through it. You cannot make an economy resilient by protecting the part of it that was already protected. So why are they not buying? Why are the potential policyholders not purchasing a policy? Affordability is the answer that gets given the most. And I don't want to be dismissive about it. A premium that looks trivial in this room is a real decision for a household choosing between cover and inputs. But I think affordability is a symptom more than a cause. Because even where the price is right, people do not buy what they do not understand. And that comes to consumer education, which I'll touch on a bit later. They don't buy from an institution they do not trust, and they cannot buy what they cannot reach. Understanding, trust, access. Price sits underneath all three, which is precisely why paying premiums in grain rather than cash is a more interesting idea than it first appeared. It's not a discount, it's a redesign of when and how the customer pays, built around how the customer actually earns. And paying in kind is not a new idea. It's older than paying in cash in its entirety. And let me take the one thing I flagged earlier, which is trust. We ask people to hand over money every month for something invisible against an event that may never happen, on a promise that an institution will be there. That's an enormous act of trust, and it's only rational to extend it where the record supports it. Where savings have been eroded, where long-term promises have not held their value, where people have watched something they were told was secure lose its meaning, that trust has to be earned back rather than assumed, which means the first product this industry sells into an informal market is not a policy, it's a track record of paying. And that's exactly why those 1,800 payments in Goromonzi were worth more than their face value. 230,000 US dollars does not move the national economy, but it's evidence. And evidence is the scarcest input this industry has. And within that market, exposure is not evenly spread. Women hold less land title, less access to credit, less access to formal financial products of every kind. And across this region, they do a large share of the farming on the smallest plots with the least protection, which leaves us with something uncomfortable. The people most exposed to climate shocks are the people our industry reaches the least, unfortunately. Now, I need to be careful here because there's a version of that point that belongs in a development report rather than a room like this one. So let's talk about it commercially. If you are trying to reach the informal economy, and the informal economy is disproportionately women, then any distribution model that screens on land title, on collateral, on a formal employment record is not a neutral design choice. It's a decision about who your customer is. And it's a decision most of us made by inheritance rather than by intent. The encouraging part is that this one largely fixes itself when the reach is fixed. And I'll come back to that later again, because there is a market on this continent that has proved it. And I've got a specific case study example that I'd like to share with you. But here is the half I find more interesting commercially. Insurance is not only a safety net. It's an engine of growth. Insurance is not only a safety net, it's an engine of growth, because a farmer who knows that one failed season will not ruin her behaves completely different from one who does not. She doesn't hoard, she invests, she plants more, buys better inputs, keeps her children in school. Protection is what converts survival into growth. And growth is what creates the customers, the premiums, and the economy that this entire industry depends on. Which means the uninsured majority is not a social problem sitting outside of our business. It's the ceiling on our business. And we built that ceilings ourselves. So what do we actually do? The obvious answer is to build climate products, and we should. But the bigger opportunity is not a new line of business at all. It's integrating climate risk into everything we already do. So integrating it into underwriting, into risk management, into product development, and the investment decisions. And I mean integrating, not adding. Not a climate committee, not a climate lead, not a paragraph in the annual report. I mean the question being asked inside the existing underwriting meeting by the existing underwriter about the existing book. Because climate risk is not sitting in a separate box waiting for a separate product. It's already inside our motor book, our commercial book, our credit exposure, and our investment portfolios. And once you see it that way, or once we see it that way, it changes what an insurer is actually for. We have a role here not only as risk carriers, but as risk advisors, as investors, and as catalysts for adaptation. 4 roles, and I would argue we only really play the first one, which is risk carrier. We take the risk, we hold the capital, we pay the claim. It's what our licenses describe and our balance sheets are built for. And it's necessary. It's the jobs we get paid for. It's also in principle the least differentiated thing we do. And in principle, anyone with capital can carry that risk. The second, being risk advisor, that's the one where the real value sits. A risk advisor does not wait to be told what happened. It tells a client what will change their risk, before it happens. Which crop is more drought tolerant on that soil? Whether drainage, storage, or seed selection would change their profile and therefore their price. We hold more data about how things go wrong than almost any institution in this economy. We use it almost exclusively to price and almost never to advise. The clients who take your advice and does not have the loss is worth more to us than the client who has the loss and gets paid. The third part is investor. And this is the one I suspect we think about least, and I alluded to it earlier. We hold long-term capital across this industry, across this continent, and it's a serious pool of patient money, and where it goes shapes what gets built. Now, many of our investment mandates will mention climate somewhere. And we may have an ESG paragraph, and some of us will have real exclusion screenings for our asset managers to work on. But I would be surprised if a single mandate in this room connects the investment side to the underwriting side, and that is the gap. Every investment decision is already a climate decision, whether anyone has written it down that way or not. So let's make it real. Financing irrigation, refrigerated storage, resilient housing, or renewable capacity builds adaptation into the economy we insure. Financing the alternative builds exposure into it, an exposure that eventually arrives back on our underwriting side as a claim, which means we can be underwriting the risks our own investment portfolio helped create. Very few insurers have ever looked at both sides of that balance sheet together. And the fourth and final one is catalyst. Insurance has the power that regulation often doesn't. A price signal moves behavior faster than a rule does. When cover becomes cheaper for a resilient building or a drought-tolerant crop or a protected supply chain, the market adapts without anyone being compelled. Now, none of this is theoretical. There are African markets further down this road than we are, and the most instructive one is Kenya. And I want to walk you through it because it's the closest thing we have on this continent to the layered system I've been describing, and because its story is not one of overnight success. It's the one of 40 years of trying. Kenya's first attempt goes back to the 1940s, a government scheme too costly and too inefficient, scrapped in the 1970s, and then nothing much for 30 years after that. Then, in 2009, a small pilot called Kilimo Salama, which means safe farming in Swahili, did something different. It used weather stations and mobile phones to sell index-based cover to smallholders. Parametric delivered down the mobile money network, and it worked. The pilot became a company. The government came in behind it. A livestock program was developed in 2015, a crop program in 2016, with premium subsidies to make it affordable. And then in 2023, not so long ago, Kenya did the thing almost no African market has done yet. It pulled all of it into a single national framework, what they call the National Agricultural Insurance Policy. By 2024, that framework covered 40 of Kenya's 47 counties and more than 1.8 million farmers. Now, I need to be honest about what Kenya is and is not, because we deserve the real version of it. It's not a finished success. Insurance penetration in Kenya, in Kenyan agriculture, is still below 1%, similar to the rest of the continent. And it leaned heavily on subsidies because people cannot afford the premiums. And it still struggles with fragmented data and a regulated category that does not quite fit. But, and here's the but, it proves the thing can be built, and it proves what it takes. The pilot works. Three things, and they are the three I have been putting as part of this talk this morning. Firstly, every layer connected. Kenya did not pick parametric or indemnity. It runs both. Index-based cover for speed and indemnity for accuracy. And it transfers the catastrophe tail to the reinsurers through quota share treaties, catastrophe bonds, and weather derivatives. Second, the state as a market shaper, not a market maker. The government didn't become the insurer. It set the framework, subsidized the premium, took money it had historically spent on disaster relief, several billion shillings a year, and redirected it into risk financing instead. The World Bank, the IFAD, and the European Union came in behind it. No single party built it, and it was a coalition assembled deliberately and led from the front by the state. And the third part, distribution and data that already existed. In Kilimo Salama did not build a branch network. It went down the mobile money network that was already in every farmer's hands. and it priced off satellite indices and automated weather stations, not loss history it didn't have. And now the thing I said I would come back to, that program in Kenya reached 42% women. Not because anyone ran a gender campaign. Nobody set a target, nobody wrote a policy. It happened because when you distribute down a mobile money network and price off satellite data, you stop screening people out through branches and paperwork and collateral that they were never going to have. Reach the market properly, and inclusion stops being a target. It becomes a byproduct. I'd like to share one more example from West Africa because it answers a different question. In Ghana, a mobile operator and an insurer built something together. Life cover, given free to customers in proportion to how much airtime they were already buying. The operator paid for it because it stopped customers leaving. The insurer reached 1 million people it could never have found on its own. And when that product launched, barely 5% of adult Ghanaians had any insurance at all. That single product more than doubled the size of the insurance market, and more than 9 in 10 of the people it covered had never held a policy before. That's not a better product. It's a better answer to the question of who already has the customer's trust and the customer's money. Kenya and Ghana are not the only ones. There are many others on this continent building in the same direction. But hold Kenya in mind because of what its 40-year story tells us. The product was never the hard part. The hard part was distribution and trust and connecting the fast money to the accurate money. Kenya did not solve those with a better policy document. It solved them with a coalition, a phone, and a state willing to shape the market. Which brings me to the sharpest thing that I'd like to leave with you. For over a century, insurers have competed on one axis or one type of metric. How reliably we pay, how fast we settle, how fair we treat a claim. And everything we measure sits downstream of the loss, so after the event happens. And I think that the next generation of African insurers will compete somewhere else entirely on how effectively they help prevent the loss before it happens. Because remember, if we don't pay a loss, the loss ratio is 0%, which is everything we'd want. And I want to make the commercial case for that, not the moral one. A loss prevented costs nothing to settle. Apart from the actual payment, no claims handling costs, no assessor, no dispute, no reputational damage, no customer complaints, no reinsurance recovery to negotiate, no capital strain. It is, without exception, the highest margin outcome available to an insurance business. And we have known this for a century in fire, for example. It's why sprinklers earn a discount and why we send engineers to inspect the factories. We simply never extended the logic to climate. Extend it and the picture changes. If a farmer's cover is cheaper because she plants a drought-tolerant variety, you have not lost premium, you have removed a loss. If a business qualifies for better terms because it holds 3 months of water storage, you have not given away margin, you have prevented a claim, kept the customer solvent, and kept a premium on your book for another decade. And here is why I'm raising it now rather than in the abstract. Prevention requires warning. And for once, we have some, not certainty, warning. Months, not days. And to be fair, there was warning in 2023 as well. What was missing was anybody doing anything differently because of it. So the question is whether this industry does anything differently this time. And prevention is the one thing a foreign reinsurer cannot do from Europe. A foreign reinsurer can price African risk. They can carry it, but they cannot walk on a farm, understand a district, or advise a client in a language and a context they do not know or understand, which makes prevention the natural competitive advantage of the African insurer. The one part of this business that cannot be done from somewhere else overseas. So let me be practical, because none of this is worth much as just a diagnosis. 5 things we could actually do, and I'll list each of them. The first one that we could actually do is price the correlation. I said earlier that a drought takes value of your assets. At the same moment, it's adding to your claims. And here is the other half of that, which I found so fascinating as I was researching it. El Nino and La Nina are 2 phases of one oscillation. What they do is reorganize where the rain falls. And you don't have to look at another market to see it. Look at Zimbabwe's own last 3 seasons, a drought that destroyed most of the harvest, then floods that killed people and damaged hundreds of schools. And now we're forecasting another drought coming soon. same country, same underlying driver, opposite perils. And if we hold drought exposure in one market and flood exposure in another, we often believe we are diversified, but we are not. We have one exposure expressed in two different directions, which means we're not spreading our risk. We're doubling it. We either win twice or we lose twice. So a question for whoever prices the treaties: when they were last priced, was that correlation actually in the model? Or did it just look like two separate risks in two separate places? And a word on data, because it gets talked about most and used the least. We don't have a data problem in the way we usually say we do. We have a data use problem, because this industry already holds decades of loss records, claims patterns, and exposure information. What it does not do is join that to weather data, to satellite indices, to yield records, or to the payment history sitting with the mobile operators. The gap is not collection, it's connection. And connection is cheap compared with everything else on that list. Now, the second thing we can do is build the response layer commercially. Parametric cover does not pay your loss. It pays when a defined trigger is breached. Rainfall below a threshold, a satellite index crossing a line, no assessor, no claim, the trigger fires and the money moves. And you don't have to take my word that it functions in your market. You own the pool that proved it. And Goromonzi was a trigger firing on an index in your market on a peril, and the money reached the farmers. But we need to be honest about the weaknesses in parametric, because this room would see through anything else. Parametric does carry basis risk. Basis risk is the gap between what the trigger says happened and what actually happened. And for example, the satellite could say it rained, but the farmer on the ground knows that it didn't rain. Parametric pays a trigger, not a loss, which is precisely why it cannot stand alone. So the third part, what we can do is connect the layers. I mentioned Kenya running everything in one system, and here is what that actually means. Climate protection has to do three genuinely different jobs. It needs to respond fast before the worst happens. It needs to settle accurately, so the person who bore the loss is made whole, and it needs to rebuild capacity. So there is cover available next season and the season after and the season after. It's a long-term game. And in this market, all three exist somewhere. Parametric exists, and we built it. Indemnity exists, and reinsurance exists. What doesn't exist is the handoff between them. Now, let's take Goromonzi farmers again. $65 arrived quickly, and it mattered. It bought seed for the next season, but it was never going to make anyone whole. And nothing carried them from that payment into cover that would. Nothing even carried them into the next season's policy. Nothing carried a household from a parametric payout into a settled claim. Nothing feeds one season's experience into next season's cover. The failures do not live inside any one layer. The layers work exceptionally well. The failures live in the spaces and gaps between those layers. The fourth item that we can do: stop trying to build distribution and rather plug into it. The infrastructure to reach the informal economy already exists. It's simply not ours. Africa skipped a generation of financial infrastructure. Most of this continent never got a bank branch. It went straight to mobile phones. And in Zimbabwe, Zimbabwe is one of the clearest examples where, by the Reserve Bank's own payment figures, the country has over 10 million active mobile money subscribers and just over 500 ATMs. And the cooperatives, buyers, and input suppliers that farmers already deal with touch millions of people with a commercial relationship and a payment rail already in place. The distribution belongs to the telcos and the buyers. The data increasingly sits with the satellite providers and the agri-tech firms. The concessional capital that makes early premiums affordable sits with development finance. The enabling framework sits with the regulator, and there's now the sandbox, created specifically to give new ideas somewhere to be tested. And the risk pooling that makes a thin market viable sits quite naturally with a body like this council itself, and it already does. The insurer that wins in this market will not be the one with the best product. It will be the one that assembles the best coalition. A parametric crop cover sold at the moment a farmer buys seed, priced off satellite data, triggered automatically, paid into a mobile wallet, with the premium settled in grain at harvest. Every component of that is working today, and most of them are working exceptionally well in Zimbabwe. Satellite indices, remote sensing, increasingly artificial intelligence to price perils where we have almost no loss history. None of this is science fiction. It simply hasn't been assembled at scale in Zimbabwe or in Southern Africa. And finally, the fifth item, we need to teach the market. I mentioned consumer education earlier. This is the one we often skip, and I think it's the one that decides whether any of the rest works. And we already have the sharpest evidence for it. This case study has been said by me over and over this morning. It's not a pricing failure. It's not an underwriting failure. It's the market does not yet know what it's being offered. So we need to educate the consumers. In many of the markets we are trying to reach, insurance is not distrusted so much as unrecognized. In many of the markets we are trying to reach, insurance is not distrusted so much as unrecognized. The idea of paying money every month in exchange for nothing visible against something that might not happen is genuinely strange if you have never seen it work. And a product nobody understands does not get bought, however elegantly it's priced. Customer education is not marketing, it's market creation. Every insurer that has scaled in an informal economy has had to teach before it could sell. Through cooperatives, through community structures, through people the customers already trust. If the majority of the economy is informal, then the industry that teaches it first will own it. Now, let me close. Africa did not cause the crisis. We are warming faster than the rest of the world for emissions we didn't produce and paying a permanent share of our output to adapt. The tools we were handed were designed by the economies that caused it, unfortunately, for conditions that look nothing like ours. But I don't want to leave you with a grievance, because grievance is just not a strategy. We spend a great deal of time speaking about ESG, but more specifically the E in ESG, the carbon, the disclosure, the reporting. But in this region, the E is only the cause. The S is the point. The damage here is social. It's measured in children out of school, in a household that insured its car but could not insure its livelihood, in a woman farming 3 hectares with no protection at all. And finally, the G, the governance part, simply whether we do this properly, which is the work of aligning regulation to a risk that is changing faster than our frameworks are. That work is underway in this market already, and this room already sits closer to its regulator than most industries ever would. And before I finish, let me say something just quite plainly, because I've spent this whole session on a problem. This is a brilliant time to be an African insurer. It's a brilliant time to be an African insurer. Not an easy one, but a good one. The tools exist that didn't exist 10 years ago. The distribution exists. The regulator is building the room to experiment it in. And a market that nobody could reach is reachable for the first time in the history of our business. And most industries never get a moment like that. So let me leave you with the opportunity rather than the grievance. The majority of this economy is outside the formal insurance system. The largest protection gap on earth sits on this continent, and the technology to reach it already exists. And the mechanism has been proven in Zimbabwe by this industry 2 years ago. Because the 1,800 farmers is not a market, it's a proof. And the distance between a proof and a market is not invention, it's a decision. There's a planting season coming that none of us can predict, and all of us can prepare for. And I opened with a question earlier, and I want to end with it. If climate risk is reshaping every sector of the economy we insure, how should it reshape the way we design insurance? And I don't think anyone is coming to answer that for us. The institutions that we would have to, the ones that understand this market, that know what a Zimbabwean farmer actually needs, that can price an African peril honestly and reach a woman on a small holding with a product that finally fits. We're all sitting in this room already. Thank you.